Good morning. Today is Tuesday, May 24th. In honor of my sister's birthday, we were just actually looking at some Moses Lake, Washington population statistics, household income levels, geographic population diversity. Uh, Diverse population, not so good on the income side. And yeah, I don't know if you'd want to buy a municipal bond for Moses Lake, Tom.
Yeah, Ben's hometown average per capita income 16,644. So about one third of the poverty line. Really tough look for old Moses Lake, Washington.
It's okay. I think they're getting a few more. They have very cheap energy, and we might get a Tesla plant there sometime. It's at one of the solar city things. All right. Into the economic news. Across the pond, the UK economy is kind of sputtering to a halt. We had the May Purchasing Managers Index released. The manufacturing PMI was 54.6, down from 55.8, so not down a ton. But the services PMI was down to 51.8 from 58.9. So that side of the economy in the UK is really, really hurting. And if there's something we know about the UK is that they are ones for austerity. If there is a choice, if all of a sudden things start to look a little bit bleak, they will run to the other side of the boat. Obviously World War II, but even coming out of the great global financial crisis in 2008, these were the ones in 2011 who talked about, and to rapturous applause, the age of austerity. Tightening the belts. We're all in this together, and that's how they operate. And so, with inflation running there at about 9%, they're just saying, you know what, we're going to eat bread, and that's about it.
Porridge,
yeah,
right. That's what they eat, right?
And maybe cut back on our tea consumption. So that's what's going on in the UK. I think that's a dramatic view of how Europe will look. I think that the UK will probably be able to rebound a little bit better because they're so aggressive on the saving. But I think it's really bad in Europe. Tom, would you agree?
Yeah, I think that obviously they've got a little bit less of a diverse economy than we do. They're very, very heavily attached to financials, which have not done very well, and with the interest rate environment are going to continue, I think, to have a bumpy road ahead, and that's going to affect their whole economy because that's where a lot of at least the upper level incomes come from, particularly in London. It's a financial city, financial hub for the world, and a lot of that money is going to trickle down all the way through the economy. Now, this is a random question I was thinking while you're saying. So the traditional English breakfast tea, does that come from India? Does that come from China? Where does that tea grow?
I think it's India.
It's probably not the UK, right? So they've probably got to import that. It's probably going up at a significant pace.
I think it's India.
Yeah. Just a random thought. Sorry, had to inject that. I'm going to look it up after the call. Report back tomorrow.
So UK doing not so good. We do get more economic data from the US over the next couple of days. So we'll be able to update you on that, especially as we look toward the Fed minutes coming out tomorrow around lunchtime. Second story we have is follow-up from yesterday. Broadcom is continuing to be in talks to buy VMware. It looks like they're going to announce the deal on Thursday. It's going to be a cash and stock deal worth about $140 a share. That's a premium of almost 50% to where VMware closed on Friday. It's still below where VMware traded all the way back in spring of 2019. It was over $200 a share. This is a good company. VMware basically enables you to be on the cloud. They call it a hybrid cloud. So you can have local servers and you can have remote servers, and you can go back and forth. So that's what VMware enables you to do. And Broadcom's trying to move into these new software-defined businesses. I think this is probably a good move for Broadcom. It fits with it. It's a strategic move. I think the price might be a little bit high relative to where VMware is now. It's not high historically. It's a good franchise. I do wonder, though, if at this point in time, people are saying, we're just going to go totally cloud. And the pandemic may have hastened that. And so, whereas some software companies actually benefited from the pandemic in terms of accelerating the migration to the cloud, VMware, which was designed to be that bridge over decades between the local network and the cloud network. It was designed to be that bridge. People are just jumping straight to the cloud network. Do you think this is a good deal? They're going to have to raise $40 billion of debt in this market to do so, Tom, which they may be able to do, especially if the investment banks want this deal to close and get the commission on it. But it seems like they could be stretching themselves maybe a little bit too thin.
I mean, I think it's a survival move. I think that they're looking around and saying, how can we move from hardware to software? How can we get on the cloud? How can we push Broadcom into the future? I mean, I talked to a buddy of mine who works over at VMware. They have a big presence here because they acquired a company called AirWatch, which was based in the old Arby's building over in Sandy Springs. And to give you an idea of kind of what they do, my friend Ross, he actually runs the servers that service the Coke Freestyle machines that you see in restaurants. So anytime one of those is down, he's probably scrambling to get it back online. So those things are connected to the cloud. All of the inventory management of, the syrups and things that are in those machines that can make you any kind of Coke. All that is monitored right here by my buddy Ross, mostly from his house, I think, at this point. So that's kind of their business, is doing those kinds of things, monitoring cloud services remotely for companies. I think it's a decent deal. I think it's interesting that if you look back to I think it was summer of last year, the CEO of VMware pieced out and went to Intel. So whoever came in to take over, which is not a company I follow super closely, but whoever came in to take that job basically went, what's the best option here? Maybe I should get rid of this company. I'll cash in, be the CEO for 15 minutes and move on and take my cash and go. So I think there's a little bit of that aspect to it as well. Come in, don't really know what to do strategically. What's the best plan? Find a buyer.
It's a big move for Broadcom. It'll be interesting to see if they get approved, even if they actually end up getting this deal through and getting the financing lined up. The big story, though, this morning is Snap, and we're going to spend the rest of the call talking about where the American consumer is. Snap Inc. Operates Snapchat. They're down 32% this morning. Basically, they came out last month, issued guidance for revenue. They issued guidance for EBITDA, earnings before interest, taxes, depreciation, and amortization. And they issued a range last month, about this time 4 weeks ago, for this quarter. They're now saying that they're going to be below the low end of that range. They didn't quantify that. They just said, we know it's bad, and it's so bad we're going to be below the low end of that range. To do that 4 weeks into a quarter, and then not give a new guidance range and just say, we're going to be really bad this quarter. That's a pretty remarkable development, in my opinion. I think it looks really bad in connection with this. CEO Evan Spiegel, he sent out an internal memo warning of a hiring slowdown. He said that they're going to continue to hire new team members, but they're going to slow the pace of hiring for unopened roles, and they're going to push some planned hiring into next year. They will continue to backfill existing positions that become available as a result of attrition, but they're also going to evaluate ways to find additional cost savings. What's interesting here is we continue to see this bifurcation. We see this bad news, and we see guidance cut, and we see hiring slow. And then at the same time, they say the fundamentals of the business are strong. We've seen this at retailers. We've now seen this at Snap. We've seen Jay Powell talk about it. At what point are we going to just say, look, the fundamentals are not good? And the fundamentals defined as, what is the consumer doing, and where is the consumer at this moment? I get that the consumer has a good balance sheet. But where's that balance sheet going? If the income statement's in a net deficit, then that balance sheet's going to gradually erode over time. And I think that's the relevant concern. And I think when Evan Spiegel, when Jay Powell, when retail CEOs talk about their businesses, they need to appreciate where the puck is going, not just where it is right now. Tom?
Yeah, I think it's an interesting, I think we're starting to see a little bit of a crack in the armor in terms of how this whole operation works with being an ad-based platform. Google is one, Facebook is one, Amazon is one, Snap is one, Twitter is one, though they're terrible at it. And apparently Snap is as well. But once the economy starts to slow and people stop buying things, if you think I got to cut back, you're probably not going to click on an ad on Snapchat or on Facebook or on Google or on Amazon or anywhere you're going. And that feeds through to some of the biggest, largest market cap companies in the world. And they're seeing, an exacerbation of slowdown, because it's like not only people are not buying things from retail stores, but they're also not clicking on the ads for those retail stores. And then if you're a freemium product where people use your services all day long, Googling things and using Gmail, et cetera, et cetera, et cetera, but they're not feeding any money into the system by clicking on ads, it kind of becomes a snowball. And I think that's kind of what we're seeing, is that snowball is melting extremely fast, because all of these things are interrelated, and it's all an engine driven to separate you from your money. But if you don't want to spend your money, then the whole thing starts to collapse very quickly. And it's kind of an interesting, it's a very vulnerable spot, I think, in the economy, especially as we've grown it over the last 4 or 5 years.
You have Facebook down 8% today. That makes sense. Alphabet, Google's parent, down 4%. That makes sense to an extent, although I do think that Alphabet, Google they have a large leisure travel business as well, which I think is actually holding up a little bit better in terms of the commissions they're getting from that. But even so, Google getting hit as well this morning. What we see when the consumer begins to pull back, so just think about yourself, is you start to think a little bit more. You don't go into the grocery store saying, what am I going to buy today? You go into the grocery store with a list, and that list ends up gravitating toward what they call the center aisles. The center aisles are those staples. That's when you go get the bag bread, not the freshly baked bread or the ones that they're selling for $5.99. You go and get the one that sell the Wonder Bread for $2.99.
Rice, beans, peanut butter, and jelly.
Exactly. Cereal.
Yeah.
So they call it going to the center aisle, and you can really broaden that out. What the ads you see on Snapchat, the ads you see on Facebook, the ads you see on Instagram, they're not center aisle products. I mean, people talk about all these products that they purchased on Amazon or Facebook or wherever, and they're these random products that you've never seen before. Those are not center aisle products. Those are those ones where you first come into the store and they say, look at this new cool product that we have. That's what happens when you go into the store without really minding what you spend money on. That's not what we're seeing right now. Amazon, to that point, is actually continuing to try to get rid of its unneeded warehouse space. They bought a ton of extra warehouse space last year because they thought they were going to need it. And they ended up having too much capacity. So what they're trying to do now is they're trying to sublease a minimum of 10 million square feet of warehouse space. They're also trying to end or renegotiate leases with outside warehouse owners. A lot of this is in New York, New Jersey, California, Atlanta. They've previously said that they were going to try to do this, so this isn't a surprise, but now we're starting to see how the sausage gets made. And a lot of those warehouses are not happy. Where this feeds through the financial markets is on the real estate investment trust side. A lot of people have been buying industrial Reits, is what they call them, because of their positions in warehouses. So I would be a little bit concerned with some of that part of the market as well if they start to see some cracks. Tom?
Yeah, I mean, I think it's really a reaction to the lockdowns, right? I mean, when everyone was locked down, you had to order stuff online for the most part. If you couldn't find toilet paper in stores, Amazon is where you turn, and toilet paper takes up a lot of space. A lot of these staples take up a lot of space. And so my concern, and maybe even it could be positive, is that, we've got Costco reporting this week, and they are a warehouse, with a cash register up front. And it could go one of two ways. One is people aren't spending money, and so that hurts Costco. The other is people are only buying staples, and perhaps that's flowing a lot of that demand into something like Costco, where you go to buy, 1,000 rolls of toilet paper or a giant tub of peanut butter or, the ultra giant boxes of cereal. I'm interested to see how that comes through, because a lot of this stuff feeds through. But my thinking is, if people are really cutting back, is that a place that actually is a net benefit, or are they also getting crunched on the consumer? And that's a company, we like quite a bit. They've done a great job with handling the supply chain issues and pushing through costs, the question is, are they going to be another victim or are they going to be a winner this week? That's all this stuff, reading about Amazon cutting back warehouse space. My thoughts are, how is Costco going to do?
Yeah. Yeah, I agree with you. Best Buy, Abercrombie, and Fitch, AutoZone all came out with earnings today. Abercrombie and Fitch, really the big negative. Gross margin missed really badly. They have a lot of inventory. They're saying that they're not really seeing much of an impact on sales. They're actually getting price increases right now, not big markdowns, but that kind of belies the fact that their margins underperforming. Best Buy was actually a little bit better than expected, driven by appliances. Again, going to the center aisle, fewer TVs being purchased, fewer personal computers being purchased, but more appliances. And so they're a little bit internally hedged there, although, and then so those numbers came in broadly in line with estimates, but bear in mind, U.S. same-store sales were still down 8.5%. So not a great situation for Best Buy, but given where expectations were, it was okay. With that, we're going to leave it there. We'll see you tomorrow. Have a great day out there, and we'll be here right back at 8:30 tomorrow.